So our next speaker for the day is Mr. Girish Chand. So Mr. Girish Chand heads the MCA Gulf compliance practice covering the corporate tax, VAT, ESR, AML related areas across the GCC countries. He has over 6 years of consulting experience and over 25 years of experience in finance and audit executive roles. He currently serves as a director on the board of a few Mauritius-based entities. He has 10 years 10 years experience in finance leadership roles in the downstream oil and gas business, covering marketing, retail, and trading. So, ladies and gentlemen, please put your hands together for Mr. Girish Chand.
Good morning, everybody. Welcome back after the natural break. Okay, so I think definitely I should thank George for basically inviting me to the Abu Dhabi chapter. My experience with the Abu Dhabi chapter earlier has been a webinar where I did not have the opportunity to see you all face to face. So definitely this is a very welcome opportunity. And of course, coming to Abu Dhabi also ensures that your green status is updated. So, right, so I'm, at least negative, right. I think the introduction of corporate tax in UAE, okay, is definitely something that, like we did our qualification, maybe for people like us 3 decades ago, okay. So there was always the element of a qualification which was possibly not getting used fully, okay. So maybe now what we will see is that the chartered accountant degree, right, gets utilized fully in this part of the world, okay, and hopefully as professionals in the practice, of course, we benefit, yeah, but as also professionals in the industry, right, and I think the recognition part of it will increase for us as qualified professionals. So we should be thankful to the UAE government for kind of introducing or the corporate tax coming in. VAT brought in a complexity. Obviously, when we talk about corporate tax, there is the additional element of complexity that is coming, okay. So like Umesh did, maybe I'll ask a question, okay. So how many of you all think that we should start preparing? Please raise your hands. Okay. Now the next question is, how many have started preparing? So this is very typical, okay, of we saw it during the VAT regime also, right, where in terms of when the law was coming in, I think we are waiting for the law to come, okay. When the law comes in, we still have a population which says that let the regulations come, okay, and even when the regulations come, there is still a population which says that let the implementation date come, because there is a possibility that they might not implement, okay, and that is what we saw during the VAT regime, okay. Obviously, us as professionals, I think we do not belong to that camp, okay. Like George mentioned that there could be so many topics that we could have had, okay. But basically the Abu Dhabi chapter chose to have corporate tax second time, right, which basically kind of indicates the importance that we as professionals are giving to this particular topic, okay. And definitely it is welcome, okay. My presentation is largely talking about that only, in terms of when you look at the implementation, it's a journey, right. There are things that you can do right now. There are things that you can do when the law comes in, and there are things that you can do before the implementation date. And of course, once the implementation date starts, it is like, a match, right? You have a practice and then you are actually into the match, right? So you have to basically perform, okay? So that's what this whole presentation I will talk about. Hopefully there will not be too many jargons. I'll try and keep it very simple, okay, because this is about how as organizations we would prepare for the corporate tax journey, right. So this is the broad outline in terms of saying that, why do you bother about it now, There is no law, there is no regulations, there is nothing there. But actually speaking, there is quite a bit of, like they say, the information available. And in fact, at least my estimate is that we can be about 50% ready, okay, at the current state. And this has just got to do with not only the public consultation document, but if you look at the region around, right. So it is not that corporate tax is new, okay, and even if you leave the India experience, in this part of the world, there are economies or there are countries where corporate tax is being practiced, okay, and it has been in existence for some time. So there are enough parlance or enough examples which you have in terms of what you need to do in terms of a preparation perspective. Okay, the element of key risk that you need to avoid, the implementation journey, the various elements, I'll take you through in detail. Okay, the first part of it is why do we bother now, right? I think this was true when we talk about 2018, right? This was an element where effectively this place did not have any form of taxations. Okay, now VAT has come in, right? VAT has possibly covered the indirect tax or the basically what is related, I would say more on your top line related one. Yeah, primarily it is about your sales and your purchases, yes, to a certain extent about your expenses, that is what VAT would cover. What we are talking now is about a direct tax, and a direct tax effectively says bottom line. Okay. When you talk of VAT, at the end of the day, it did not impact the organization, right? Because if you were doing it correctly and you didn't have efficiencies in your inefficiencies in your organization, there would be no impact on your bottom line. But this is a tax which will have an impact on your bottom line. So that's where the importance comes in more, okay? Because you as finance guys, okay, as CFOs, okay, head of finance, obviously what you're now going to talk to your management or to your shareholders is the impact that the tax is going to have in terms of the net that the company is going to take home, okay? So effectively that is where the importance comes in. Okay. We have varying degrees of accounting practices, right? All of us who are in the consulting sphere see it. Okay. There are some organizations, we are also seeing it, some of them where you have to convince the management about maintaining the books of accounts. Okay. We tend to still see invoices thrown at us, whether in form of their invoices or the invoices that they receive, and kind of saying fine, file the VAT return. Obviously, every time we file it, we also put in a caveat and say that, by the way, you are expected to maintain books of account. So we are seeing that, of course, it is largely restricted to the individual or owner driven organizations per se. But that is the one extreme. Okay, even where accounting books are maintained, I think there are varying degrees of professionalism of how those accounting books are maintained, right? So that's something that we will see. And when we come to audit, okay, and sadly, I don't know whether even the public consultation or even the law is kind of, it's not putting that word mandatory, right? Okay, as far as this, it is left to the respective authorities in the jurisdiction to determine whether an audit, has to be conducted or not to be conducted. Hopefully, yes, that practice will kind of, kind of be, basically not negligent, right? When obviously when you have to try to justify your net income, right? So that will kind of become negligent. But as things stand today, we are having this varying degree of accounting as well as audit that is being practiced. Okay. I think more important is this bit of it, right? Which is of relevance to us, because this is about the business sustainability and profitability. Because like I mentioned earlier, it was a case of possibly not having an impact as far as VAT is concerned, but this is something which is going to have an impact on your bottom line. So moment the net number gets impacted, I think we need to start working backward, right from where we talk about how we basically price our products, okay, how we basically manage our cost, right, and how do we manage our expenses, right? All of this starts getting important. So that is where when we talk of something like this being introduced, this is the impact that it is going to bring about, is in terms of looking at your entire profitability of the business. Okay, and you need to start thinking differently, because practically like 10% of what you used to show as a profit would basically get disappeared. Okay, and maybe it could be more, because there is an element of also what we talk about, what is allowable. You might be showing your book profit, okay, but what is actually your profit on which you would end up paying your tax, that could be different, and that could be different upon again how much an owner driven organization it is, and how much of other expenses are being booked and which are currently being allowed, like possibly Umesh mentioned. Okay, and of course whenever you have this 10%, the cash flow related impact, and I already spoke about the system of recording and documentation that needs to be in place. Okay, the other element which comes in is about also how about structuring of the organization, right? I think Prateek basically spoke about in terms of the various elements when we talk of from a corporate tax perspective, whether it is in terms of you wanting to form tax groups, okay, whether your organization is based in mainland, okay, or in free zone, or whether the organization is getting impacted because it's a permanent establishment and possibly it is going to get coming under the corporate tax regime. So all these elements are something that is relevant from a structuring perspective. Okay, so that's where I think the thought process has to start, and then we talk about how the journey of implementation as far as corporate tax is concerned. Okay, usual stuff about whenever we talk as chartered accountants, as finance guys, what are the risks and what we need to avoid. Yeah. I think this is a good example that where we are starting the journey, right? And this journey for most of the organizations, I think basically Umesh mentioned, 16 months, right? And 16 months is looks very long, okay? But when we start looking at what needs to be done, maybe it's just the time is right, okay? So effectively, when we talk about preparation, right? So that's something that we need to avoid the risk that we are not spending enough time in terms of the preparation part of it, right? Now, if we don't understand the legislations and laws, there is a very easy solution, which is called penalties, okay? So, and I think maybe some of us have seen the impact of that in terms of, what the penalties can be and what the on the organization it can come about, okay? Whether you are currently in the VAT regime, if you are not filing on time, okay, treatments are not there. I am sure, I think majority of the people in the room have still not seen the VAT impact, okay? Because I think the only people who have seen the VAT impact are who are claiming refunds, or God forbid they have been kind of subjected to a tax audit, okay? But still a lot of organizations have not seen the tax audits as far as VAT is concerned, and that's true similarly of when we talk of the corporate tax. This is down the line, right? But we are 4 years into VAT, and sometimes I don't sleep at night because of the clients that we handle, and despite us checking, there is still such a lot of thing, and such it could be a simple transaction which could have ramifications across what do you call across years, okay? And sometimes if it is across years, because we didn't have the VAT audit for practically 4 or 5 years, right? Because whenever the tax audit is kind of initiated by the FTA, it starts from 2018, okay? And we are sitting now in 2022, right? Inshallah, but there's 6 years that is mentioned. So basically, we still have some time, but the only element which we keep advising clients is that it is not about the year or something, it's about a process and a system, right? Whenever you do a VAT filing, if for that VAT filing you have ensured that your entire documentation and what is required to be done is maintained, that's a simple methodology, okay? We cannot take it as a project, because I think a lot of the organizations are taking as a project, and these projects are moving from a year, now it is a 4-year project. Okay, if and when, if you are required to produce, and I think some of the guys who have experienced, some cases it is 5 days, within 5 days to produce those documentation, right. Of course, you can ask for time, but that's something which is there. So, I think in that context, anyway, I think I am slightly digressing, but that is where it is the importance of understanding the legislations and the regulations become of paramount importance. Again, the same about when we talk about a tax treatment, right, do we understand the treatment, right. If we do not understand the treatment, I think, and obviously when we put 3 consultants, we always have different opinions, okay, so that is fine, right. So, like I keep saying, we will have many lawyers, but there is only one judge, and that judge is the tax authority, okay. Again, in terms of how your control systems are built in for the transactions, right now, when we talk of from a corporate tax perspective, right, what we are saying is that there is the element of allowable transactions and which are not allowed, okay. And today possibly that distinction is not being made. Maybe there is a little bit of experience about personal related expenses from a VAT perspective, where I think possibly you would have seen is that when we talk about mobile phones, okay, whether we talk about car related allowances, right, these elements of it we are getting an experience as such, right. But there are still things which are getting pushed into the thing, into the particular, and we are saying that these are business related expenses, yeah. But when we start getting into something like the corporate tax, they also will get of more paramount importance. Okay. When we talk about any implementation, right, largely they are around 4 pillars. Okay. So, these are the normal pillars of whenever you get into system implementation, right, and these are again relevant for when we talk about an implementation from a corporate tax perspective. Okay. Structure, we understand structure, right, what is the element of basically when you talk about an implementation, how do you need to implement structures, okay, and these are relevant when we have multiple companies, and I think I am sure most of the people in the room are dealing with multiple entities, right. So, then the structure does get of paramount importance. Okay. Transaction processing, again what we are referred to is that the various transactions that we have. Okay. So, we need to start kind of basically kind of ensuring that our systems are geared up in terms of those transaction processing. Okay. I think the element of systems also comes of importance. Okay. What we have seen is that even in context of VAT, right, what we are seeing is that a lot of the entities have got beautiful systems, they have SAP, Oracle and all that, but after a point then there are these downloads, and then we have some wizard in finance who kind of puts them together on Excel spreadsheets, okay, and then we submit the VAT return, right. So, effectively what we are seeing is that the manual intervention starts coming in, okay, when we talk about the VAT filings. Okay. The same question would arise, okay, what is the extent of manual kind of thing. Of course, you cannot rule out, okay, that is I would say layer of control, right, but to say that if you are going to do everything on a manual basis, okay, then that element of it will bring in a certain risk in terms of seeing that are they actually getting accurate. Okay. So, that is where the system would be of importance. Sorry. Training of communication, I think this is an element where, okay, ICAI is basically doing it for its members. The question is within the organization, how does it happen, right? How do we train, first of course the finance guys, yeah, but there is an element of training to the management, okay, there is an element of training to possibly the stakeholders, because sometimes some of these things are also going down to the salesman. Why salesman? Because there could be an element of pricing that we are talking here. Okay. So, that is the kind of training and communication within the organization that possibly you need to build on. So, when you talk of an implementation, these are basically possibly the pillars on which you can build your implementation strategy. Okay. Now, again, I am making it very simple possibly, but yeah, just to give you a broader parameter of when we talk about the implementation. Now, this is from a little technical perspective. So, what are those pillars that we look at when we are going to kind of go about a corporate tax implementation? Okay. So, the first pillar is obviously the structure. I think the element of saying that what do we do? Okay. Do we register all our entities as separate entities? Okay. Do we kind of form tax groups? I think we understand, in terms of a tax group what is involved. Yeah. So, it's slightly different from what we had in the VAT context, okay, where you could have a majority kind of control of 51% and that would be enough in terms of a tax grouping. However, when we talk of it from a corporate tax perspective, we understand that effectively if you were to form a tax group, you require how much? Yeah, see, actually I am not required, you guys can do. So, basically 95% is there. So, there is a big difference when we talk of a tax grouping, but since as we know the nature in this part of the world, there are always a majority holding. So, yes, there could be where you could look at this, okay, in terms of forming a tax group, right. The other element also which comes in is that they also talk about where you could basically kind of transfer the losses, okay. So, effectively there you can do that with how much shareholding? See, I think consultants. Yeah. So, these are all the considerations that would come in terms of when you are looking at possibly getting ready, right, from a corporate tax perspective. I think an important element, I will not talk too much because then Markus will get angry on me, okay, but basically the element of when we talk about related party and connected persons, and this is very, very relevant for this part of the world, okay, because I think we say that personal and business they kind of cross the lines very often, okay. So, what happens when we talk of either a related party transactions, how do we kind of take care of those, okay. Also relevant is the element of connected persons, because the owners of the business are kind of involved with the business and there is the personal element coming in, okay. So, effectively how do you kind of recognize those and start preparing to say that whatever is the the profit of the organization, that is basically reflected correctly, because the expenses, some of those expenses might not be relevant for corporate tax. And the natural corollary and which we love, okay, in terms of what happens, right. So, no longer it is what we call as the accounting profit for the purposes of corporate tax, right. We have to get to the tax profit. So, effectively when we talk about the pillar, so we need to start that exercise of starting to think that if we take our entity as of 2022, what is our tax profit, okay. We know our accounting profit, but the element of trying to find out what is our tax profit today, okay. It is not necessary to get it right, it is more important to think about, okay, what are those elements that are coming into my profitability today, which should not be taken when I calculate my tax profit. So, that part of it, that part of thinking needs to be started. I think this is one which possibly spoken less, but which is very relevant, okay, is and which we are seeing in domains like KSA, right, where it is required to be done, okay. So, where we talk about whether it is related to your custom records, okay, because the values which you are reflecting as your purchases or your imports, okay, in your books of accounts, do they match your custom records, okay. The other element which comes in is when you talk about employee related salaries, right. Now, you have a WPS system, okay, and again you are reporting that. So, just I am saying stat records because these are records that are available with the authorities, okay. So, how are those records matching to what you are reflecting in your books, because you can't simply say that this is my salaries, okay. So, what is that, how does it compare, and wherever there are like accountants we all love reconciliations, yeah, but those reconciliations, are they justified? whatever the gaps are there, are they justified? So that's something that we need to basically look at. Also, the other element is, I think the authority that we are dealing with is the Federal Tax Authority, okay? And we have already given them enough records. We have given them enough records in the form of VAT, okay? We have given them enough records in the form of our ESR submissions, right? All these are currently there with them. And so that is something that we basically need to kind of do this reconciliations to ensure that suddenly in the corporate tax we can't start giving a different set of records, okay? So this is something for us which is relevant when we talk about how do we prepare the various from a corporate tax perspective, okay? Now this is a typical journey that I have taken the liberty of drawing, okay? Maybe there might be consultants who disagree, but basically this is something which we need to take, and this is with reference to, I think, the most common parameter would be that it would be 1st Jan 2024 is where the corporate tax would apply, okay? So what do we do, right? So what we are saying is that the preliminary assessment, of course I changed the date, I used to earlier have it June also, right? But since we are in August, so I changed it to, you keep pushing that, But it effectively is that to say that as far as the preliminary thing, it started possibly January, but definitely started on 20th April 2022, okay? So what this part of the thing is yesterday, okay, in terms of you doing a preliminary kind of impact assessment, right? Now this phase, what we would like to think is when the legislations are introduced, okay, when you have the legislations in place, that's where we talk of the actual impact assessment to be done, because at least you would get a fair amount of clarity. And as far as our VAT experience is also telling us that you will never get the 100% clarity, okay, maybe you will get an 80 to 90% clarity, right, despite having the rules, the law and even the regulations, because it's an evolving subject and it needs to evolve, right. So the clarity will not be there, but you will get a fair amount of clarity, and that's where you should be doing your impact assessment. This is something that we talk as the implementation phase. It could be 3 months, it could be 6 months, depending upon what is your what you call as your extent of complexity as such. Depending on the complexity, this is where we say, right, up to December, where we talk about, this is we say from April to this, because what we are saying is that implementation phase may involve some complex things like structures also, and that is where it could take something longer period of time, okay? And basically the return filing would start from Jan 24th, so that's where you start the post implementation journey as such, okay? So I will not leave at this, I will tell you what will happen in each of the phases also, at least recommendatory kind of thing, what you need to do in each of the phases, okay? So what we talk about is what would you do in a preliminary impact assessment, right? I think we spoke about in terms of the structure part of it, okay? And since we are going to have most of the places, if it's a single one entity, your life is easy, right? But if you are dealing with multiple entities, definitely then you need to start looking at in terms of your structure and how you are going to go about as far as the corporate tax is concerned. And as we know, the VAT would not apply here, so you have to look at it with a fresh mind, right? You would obviously at this stage, definitely you need to see what is the extent of your related party transactions, okay? I think Markus will talk in length about arm's length, so good. So primarily in terms of how would you basically look at your transactions today, because I know that we decide, and sometimes the two finance managers agree what will be the profitability between each of the entities, or sometimes the management says that, by the way, put so much here, put so much here, right, and that's how you should reflect it, okay? So all that would have to be looked at, to see that are we kind of maintaining an arm's length in terms of transactions, is it reflective of what normal markets would be for those kind of products or services, right? That's something that we will have to evaluate. I think this I love, because of we are in this part of the world. So, management related transactions or connected persons, right? What extent it is, and how we are going to handle these elements of it, right? And like I mentioned earlier, you can today calculate your tax profit, right? With like they say, the percentage of accuracy is dependent on the organization as to how complex it is. Every single entity organization may be to a fair degree, right? But where you have got multiple entities with related parties and all those, possibly the element of when you calculate it, you will have a certain level of accuracy. But it is worthwhile doing that exercise starting today. So, this is what would be normally expected of a preliminary impact assessment, right? We move to the next stage, and I think like we mentioned, this is the stage where you will find similar headings. I think only what will happen is that the extent of work that you do in each of those areas would kind of increase with some some elements where you would have to do additional as such. Yeah. So, right now the law is there, now you know how it is going to apply. Yeah. You could possibly see what kind of impacts are going to come as far as your organization is concerned, right? And the clarity for you to determine, like they say, impact assessment is of saying what is the action that you are going to take. Okay. Possibly in the next phase when you actually do the implementation is where you actually take those actions, but this is where you will kind of determine what is the actions that you are going to take as far as your structure is concerned, right? Once we have this clarity, I put this in this phase, but it could be even be done in the preliminary assessment kind of area. But basically these reconciliations, I think maybe people are not thinking about it, but I think it is worthwhile that we cover this during our the impact assessment that we are doing, right? In terms of once the clarity is there, I think we can start the process of how we look at our group related transactions and the the management related transactions, right? Again, with the law coming in now, where possibly earlier if you had a 60% kind of accuracy level, I would say that possibly you can move to an 80 or 90% accuracy level as far as your determination of the tax profit is concerned. Yeah. Implementation, obviously this is a phase where, and that is where we are putting a slightly longer time, is because when you talk about structures, that is where you will have to start putting the time. Okay. Now, I think Prateek spoke about the free zones. Okay. So, the element is that when you talk of the free zones, okay, now free zones has got multiple dimensions, right? Where they say that if your free zone is only dealing with the within the free zones or outside, then in that case if it will be basically be a 0% taxation, right? But if the free zone has an element of mainland transaction, then the entire income would be subject to 9%, right? So, then the question arises is that what is that element of mainland income, right, and can it be managed differently? Okay. So, these are the elements that would come out in your the impact assessment, and this is where you start taking the action. Does it require you to create a branch in the mainland, okay, for that whatever the transactions that are happening in the mainland? Because the way I understand it from the PC, okay, is that effectively if you have got a mainland branch, then the mainland transaction is 9% and the free zone related transaction is 0%. Okay. So, I think once the law comes in, we would have today we can say with some level of accuracy, but I would not ask anybody to make any changes until the law or regulations have come, and once you have really read through it, and that is where we talk about this phase where you make any structure related cases. Okay. So, again the element of you start implementing whatever changes have to be done in your systems, okay, in terms of how do you track when you talk about the disallowable expenses, right? Today also we might not have that thing. Okay, do you start creating separate codes? Okay, how do you basically kind of provide for where you say that 50% of your entertainment expenses will be allowed, right? So what is the mechanism through which you will basically eliminate? Would you maintain separate codes so that you can easily pick it up later on when you want to basically do your corporate tax filing? So these are kind of things that you possibly need to plan about. Again, here is where when we talk about the implementation phase, I think that is the phase where you start basically doing your transfer pricing related documentation. Okay. What documentation? Markus will tell you about it. Okay. Basically also the element of whether you need to do benchmark analysis, all these would start for you to do it, I would imagine, during your implementation phase, right? And these part of it. Again, hopefully once we do all this, we'll move to a more accurate element as far as our tax profits are concerned. Okay, the last, let's not forget that we have to register for corporate tax. Okay, so effectively I think, because I'm sure that what we are seeing is that depending upon your financial year ending, there would be a time frame, maybe 1 or 2 months before, where you would be expected to register for the corporate tax. And the last bit of it is, once you have kind of done, okay, then you start getting in, like they say, you're getting into the match now. So effectively you start doing all the things that you have planned, right, in terms of the proper accounting and transaction documentation, the reconciliation, okay, preparing the actual documentation as far as your transfer pricing is concerned for the purposes of the corporate tax filing. And I think they basically talk about 9 months from the year. Okay, so in that sense we have got a lot of time. I think the preparatory part of it is where I think we have just adequate time, right? But when we talk of it, it's a year and we are required to file it by I would expect September 2025 is where you will have to do the first filing, as far as the corporate tax is concerned. I think the screen has gone off at the right time because I come to the end of my presentation. Hey, I think the questions are at the sorry. No timing is set. Sorry, this is my last slide as such. Sorry. Thank you so much for being such a patient audience.
Thank you, Girish. Please be here. Aditya missed one important point about him. He's a very good badminton player. So to hand over the memento to our speaker, Girish, I will request our General Secretary, CA Rohit Daima, Leader Membership, CA Mohammed Shafiq, and our Senior Member, Biju George, on stage